Welcome to Street Talk, S&P Global Market Intelligence podcast that offers listeners a deep dive into issues facing financial institutions and the investment community.
I'm Nathan Stovall, and on this episode, we're talking about bank liquidity, growth at this point in the cycle, how banks can become more efficient and reach top performing status in the industry. We plan to cover those topics and others at our upcoming Community Bankers Conference in May, and I've asked my colleague Maureen McKenna, who oversees our commercial bank offerings and leads that event, to co-host the episode with me. Maureen and I spent a lot of time talking together about what we're seeing in the marketplace, but I especially wanted her to join me today because our guest in this episode is one of the key contributors to the conference. Maureen, thanks for joining me.
Thanks, Nathan, for having me on the show. We're thrilled to have Chris Nichols, Director of Capital Markets at South State Bank, joining us today. Chris is also on the advisory board for our Community Bankers Conference, which we've hosted for 11 years now. And our goal for that event is to provide an educational forum where community bank executives can come together to discuss the most pressing strategic issues facing community banks. And Chris and the advisory board play a big role in shaping the agenda and the content we cover. So Chris, to kick things off, can you talk about South State's correspondent banking division, the services it offers, and your role at the bank?
Sure. I appreciate both of you for having me on the show. Always a big fan of your guys' work, so I'm honored. South State, $44 billion bank. We go between $40 billion and $50 billion, depending on what's happening with deposits, really. Loan growth has been good, so I'm sure we'll talk about that. But we have many specialty areas, homeowners associations, municipalities, payroll companies, fintechs, et cetera. And one of them is correspondent banking. That's always been our bread and butter, probably one of the largest networks out there. We've talked to some 4,000 banks, some 1,200 active bank customers. And so we have a pretty good lay of the land. We have products like our Loan Command profitability product and our Arc Hedge product, where we get to see the flows of each of our banks and the profitability of both loans and deposits. And so it gives us a pretty good insight on the industry. Not as wide as some of your data, but we do look at your data and compare it to ours to kind of match things up, and it gives us some trends.
Awesome. So liquidity has become a hot topic over the last few months, and money seems to have woken up. Banks have come under pressure in the last quarter, at least some banks. Have you seen the same experience with your correspondent banking clients?
Yeah, so same experience almost across the board uniformly. It hasn't, shouldn't come to any surprise of anyone since the Fed telegraphed their quantitative easing reversal, some time ago, and we know exactly how it's happening. As the Fed's raised rates and taken money out of the system, we've seen more competition for liquidity. And so no surprise that, the retail customer is now thinking about bonds again for the first time in a long time. The corporate customer is now thinking about money market funds and other investment, treasury bill type alternatives. And so that all comes out of the banking system. And we see that migration happening daily as more of our customers are coming in asking for, higher rates of some sort because of some competition. We have always the likes of the internet banks out there, but not only the internet banks, but the specialty banks as well, paying, 330 and 350, et cetera, soon to be 4%. You have more competition across the board. And we haven't really seen this ever in the history of banking where rates are being raised, the economy is still good, money is being sucked out of the system on the Fed's balance sheet, and we have all these banks like a Goldman Sachs and Morgan Stanley that were traditional investment banks in the past, but are now in this cycle full-fledged banks with the ability to raise FDIC-insured deposits.
Chris, I want to pick up on that, and those are all really good points and definitely well taken on your point about competition in terms of the rates some of those names are offering out there, but as well as what you can get in even the treasury market now relative to sitting in the bank. One other factor that I'm curious about whether or not you think that this has kind of played a role is that not only have we not seen this before in terms of a rate competition and the Fed draining liquidity out of the system, we've almost arguably never seen this before from a bank manager standpoint where you have this coinciding with really strong loan growth, so your liquidity is getting levered faster, plus one of our other sort of liquidity tools, our bond portfolio, is massively underwater. So I've kind of been thinking about this like, is it possible that whatever we were comfortable with our ceiling from a loan to deposit ratio, that maybe it's lower now just because of what growth looks like and the idea that can we pull from our bond portfolio or we don't want to? Do you think that's playing a role? Do you think that's a fair way to think about it?
Absolutely. More than fair. And I think that's probably lost on probably a large portion of the banking industry. I mean, growth is obviously one factor that every bank can control and does control. Unfortunately, it's dealt with less than holistically at many banks, and it's, a focus on lending. And you never want to tell your meat eaters, your good aggressive lenders and relationship managers, to slow down. But I think that's what's required in this cycle, is at least some respect for credit risk and some respect for margins. And there's no need to put pressure for on your margins, putting on bad loans. And so we've seen in the third quarter beta was around a 20% level. We've seen that pop up to 40. I'm sorry, that was second quarter of last year. We saw that pop up to around 40% in third quarter. We'll just get the data coming out for the fourth quarter, but we think it's going to at least move closer to 60-70%. And that's going to be, somewhat interesting for a lot of banks that didn't prepare for this. And so every new loan they put on the system, I think they have to really ask themselves, do I A, want to live with that credit through a down cycle? And B, do I want to exacerbate my interest rate margin risk with that loan? And I think they have to be very judicious about how they distribute credit and where they distribute liquidity.
You had a great blog at the kickoff of the year that touched on that, and it was your 5 New Year's resolutions for banks. And I think you pointed out that growth was not on that list, and that maybe we should consider shrinking. Some of us should consider shrinking, kind of with this idea in mind, right? That the idea that, are you actually creating value right now? And in fact, we saw sort of from the public markets, banks who maintain their growth goals by going and loading the boat up on CDs or borrowings or whatever, they got hit pretty darn hard, by the investment community. Do you think, I can think of a handful of banks that I saw who said we're going to slow down and let cash go out of the bank. Do you think most banks are willing to do that or considering shrinking? And if not, why not?
Yeah, not enough. Again, it's in every many bankers' DNA to just grow as fast as you can. It's everyone has a bias towards size, where they should have a bias towards scale. As we pointed out in past articles, you have to look at the quality of your growth and make sure you're growing and scaling, becoming more efficient with each lending dollar. And there's not enough respect to the, leverage that banks have. I mean, at 8 to 10 times leverage, they are, probably the most leveraged hedge fund out there. And so as you put on these loans, you're not only increasing your risk incrementally, but you're geometrically increasing your risk. And I think that comes with a lot of responsibility. And I think, step one is control your growth. Again, making sure you put on quality growth, quality customers that are not only good loans, but also good relationships across the board. You can't cross-sell them, get deposits out of them, get, treasury management fees out of them, et cetera. So I think that's step one. And, the more bankers think about how they manage their liabilities, the better off we'll be. And there's not enough respect to that in the industry as well. Most banks are geared with a loan officer, a chief credit officer, a loan committee, but very little focus on deposits and very little respect for how to build and how to structure your deposit base so it lasts through a down and up cycle.
So, Chris, you've written in that blog that many banks make the mistake of leading with rate and trying to attract new funds. Why do you think we continue to see so many banks take that approach, and we're still seeing so many promotional offerings? Is it really to fund that growth that you just talked about?
Yeah, it's to fund that growth. And, many banks didn't focus, unfortunately, when rates were low, to drive out their rate sensitive customers and put products in place to dampen the beta on the way up, and as a result, they're paying the price. And we walk into lobbies of banks all the time, 40 a week, and anytime we see a rate advertised, or we look at the paper and we see a rate advertised, we know that's a lazy bank or a lazy banker. Marketing on rate is the easiest thing to do, and I don't think we have enough appreciation in the industry of what truly destructive power that has. You end up attracting not only rate sensitive customers, but you train your employees to be rate sensitive as well. And so many of these employees have never seen an upcycle of rates that are in our banks now, from the teller to the CEO. And when you socialize the idea that when you market on rate, either in a explicit marketing campaign or advertisement, or when you start to just offer as a rebuttal to a customer's issue with rate, you start to make that okay to put rate out there, and that becomes detrimental to your customer in that you attract more rate sensitive customers, but you also, and more importantly, train the employee to think that rate is okay to market on, and rate should be the absolute last tactic in your rule book, in your checklist on how to keep that customer. You should try everything else. And so banks that say they're about service but use rate to attract and retain customers are doing themselves a disservice and destroying value, not just the short term. That customer is going to come and go, but that employee and that other customers that like that customer, they're going to be around. And I don't think many banks realize the cannibalization that goes on.
Chris, you and I were talking last fall, and you mentioned that you're pretty optimistic about the state of the economy for 2023. Since then, the market been spooked, and it seems like recession is the baseline for many financial institutions in forecasting the economy for this year. But the economy remains in pretty good shape. Unemployment, it remains at the lowest level, as we saw in last week's numbers, and GDP growth was recently revised higher. What are your thoughts on the economy for this year? Are you still optimistic? How do you think it will fare, and what might that mean for bank performance?
Yeah, great question. Kind of the $1 million question these days. I'm always optimistic on the economy. I believe that you're not going to have a recession, as you pointed out, where unemployment or employment is right now, where the consumer is. You still see all the leading indicators in terms of consumer and business spending still at their high levels, whether it's travel or whether it's discretionary spend for clothing, et cetera. You still see robust numbers across the board. And that's not going to bring on a recession. So when you see the forward curve kind of dip down at the end of this year, beginning of next year, and all the pundits are talking of a recession, including many of the Fed speakers, I think it's misguided. And I think you'll see that as hard as inflation was to rise, you'll see it very slow to go down. We'll be living with higher than expected inflation for some time. That back end rate drop in the forward curve right now will likely come out of the market. And I believe we'll be talking 6% rates before we're talking 3% rates here soon on the short end of Fed funds.
I happen to agree with you. Thankfully, they don't ask me to forecast rates. That's the hardest job in the world. But it is surprising to me that the bond market seems so sure of a pivot when the Fed has been pretty clear. I know that they've had to pivot in the past, but the economy's showing strength that they can sort of hold up those rates. And if you've heard some Fed governors talk, I mean, they don't want to go back to the 70s, right? And that's not a good place to be. And I've even heard several Fed presidents say that pretty recently. And I'm just a little surprised that anybody is positioning that way. I haven't heard it from our banks as much. They still seem to think that, rates are going to continue to move higher. But I have been kind of surprised that the market has gotten there so quickly.
Yeah, that's right. And so to my earlier comments about, respecting the credit and, respecting the balance sheet and loan growth, I temper that by only saying that I don't think there's a recession, but I do think, everyone has to pay attention to the Fed's history of overshooting. And, I think the Fed's done a fantastic job at slowing down the economy. And I think it's right where it should be in terms of the Fed move. But I do think that, here's where we get into real risk. So if the Fed were to move to 6.5% on the short-term rates side, you could risk overshooting, and that credit that you're putting on today, you have to live with for a number of years. And when you look back at any downturn, it's the 2 years before the downturn that gets banks in trouble. So if you look at 08, for example, 07, and you look back to 06, that was a pivotal year that banks made a whole lot of mistakes putting on lesser quality credits, more speculative credits, lots of land development loans, for example, many of which had problems. And those are where you make your mistake. And so I don't think we're heading into a recession. I do think you have to have a probability 20%, 25% that, hey, we could be overshooting here shortly in the next year and have to pay more and more attention to credit and margins.
And the best banks, I feel like I've learned this in my time, are are the ones who have money when nobody else has money. That's when things kind of go on sale. I mean, South State definitely benefited from that coming out of '08, and you weren't the only one sort of in the Southeast. So are you really getting that much incremental return today for reaching maybe a little bit further when if you're a little more patient, you can wait for somebody else's problems to come your benefits?
Yeah, and you can count on one hand the amount of the number of banks at last downturn that stopped lending in late 06 and 07. And it's really shocking when you look at that. And it does take some fortitude. And I always say that's kind of the test of both governance and executive management, that be able to go to your board and say, hey, I know, last year we had double-digit loan growth back in 2022, but this year we're going to slow way down, and we're going to even stop in some cases. And that's hard to do. It's hard to get that through an average banker's head in paradigm. So I admire those banks that are showing discipline, and now is the time to at least start thinking about it and start talking about it and make a proactive decision on where exactly you want growth to be and where exactly you want credit quality to be and how much resources you should be putting into deposits to make sure that you're stemming that runoff and tampering beta down.
Sure. One other piece of the discipline, it's a little bit different, but I'm curious your thoughts on it around sort of expense discipline and really trying to get more efficient. I feel like something that has been maybe a little surprising to the sell side in particular is that this expectation that everybody was going to get more efficient. The technology was going to allow us to get more efficient, and that everybody was going to focus on it. And it feels like banks have kind of consistently missed on expense numbers. And part of that, sure, is inflation and wage inflation that's gone on. But do you have any views on why we've seen a number of banks kind of consistently come up short there, and why maybe it's hard to get more efficient?
I have a lot of opinions on this, Nathan. Yeah, I think, what I call the shiny squirrel syndrome, shiny object squirrel syndrome, in that I think most banks, in the need to be more quote unquote innovative and the need to be quote unquote more scalable, they go out and buy technology without really a long-term strategic plan. And so what you see is some point solutions here and there that are efficient at that point. But when you start to combine a number of systems, they become equally inefficient as you once were. So as you think about a platform for gathering, commercial deposits versus another platform for gathering, for onboarding retail deposits versus a commercial loan system, et cetera, you have all these disparate systems still not solving the overall architecture problems of the bank, and you don't improve your efficiency. And so I think that's a lot of what's happening. We've seen a lot of activity. Banks have gotten a lot more technology focused. Unfortunately, they still don't have an overall strategic plan, and they're still doing inefficient things. Now's the time. Many banks have, not sandbagged, but they underestimated the number of Fed movements. And so they had larger than expected margins last year and produced larger than expected earnings 2022. And if you're not going to invest in your technology now and not going to take a long-term view of technology, you're making a mistake. So things like replacing your core to a lighter core, things like building out a complete platform, whether it's a Salesforce or ServiceNow, and start to build your workflows on it. Those are some of the things that we've been working on at South State and some of the things that we profess to our correspondent banks to get there and move efficiency light speed forward in large steps, as opposed to just doing these incremental improvements in point technology to potentially, customer segments that really don't move the market, i.e., student loans or, financial diversity, all of which are important, all of which should be done. But we also have to tackle the larger issues, such as core and, an LOS system for loans and a deposit onboarding system and experience management, et cetera.
Mm-hmm. And arguably, I agree with you on the timing in particular. If you're public, but true for private too. The investment community right now almost doesn't believe that the earnings are sustainable. They think we're over-earning on credit. They think things are going to come down. So if that's the case, you might not get that penalized for doing it now, and you'll be prepared to outperform in the future.
Yeah, great point. I mean, banks should be performing here on the equity side more than they are. They're not because of the reasons you mentioned, in addition to, this credit view that we're going into a recession. But now is the exact time to be investing more than ever in both technology and I would also say marketing, building the brand, building your client base up to get higher quality customers in the door so you can last through a recession should that occur.
So, Chris, to wrap it up here, when looking at top performers in the industry, what do you think they have in common? Any observations or insights?
Yeah, I mean, I think it's a combination of some of the things we touched on. I think it is one, credit and growth discipline. I think that's, step 1. 2 is a focus on deposits building and maintaining. It's easy to panic and run out and offer rate. It's a lot harder to start from the ground up and build good products that are, can be cross-sold, that retain high-quality customers with large balances and go after those large balance customer segments. I think that is a hallmark of good management. I think management with a view of technology to become more efficient across the board, particularly in areas that really move the needle, is another one. And then always I would add in there, fourth, in that having a good jaundice eye towards M&A. I think now is the time that you'll start to see more and more opportunities as many banks are going to kind of throw up their hands here, thinking that they're probably at the top of their earnings game and they're going to go down and look to sell. So making sure you can get a good price and a good cultural fit.
Great, Chris. Those are all really, really great points. We certainly appreciate you taking the time to come and share your thoughts.
Thanks for having me on. Always a pleasure.